Markets continue to bob and weave. Today, we're going to be talking about some of the big investors out there. What are they worried about, right? They're worried about earnings and they're also worried about potential recession risk. We're going to be covering both of those today in our stock market update for March 18th, 2022. Let's get to it. So what's everybody worried about? Well, I think the big investors have been selling stocks because they're worried about earnings. And so this is a really cool blog post that Alec Young put together. He did this really great study about how stocks follow earnings. So this is what the chart is. We're going to get into that in a second. But basically, Wall Street only forecasts 6% EPS growth in 2022. And that could be rather optimistic. And the reason for that he is saying is because, look, we've got elevated commodity prices, we've got high inflation, we've got high energy costs, right? That could potentially derail the consumer. So if big investors are worried about earnings, should you be worried? Well, let's go ahead and look at this cool chart. I love this chart. And it's basically showing that the S&P basically tracks the earnings, right? So the S&P is this lighter blue line. Then you got the earnings, which is this darker blue line. And there's a couple of things that I want to point out. First of all, it's correlated about 95%. So they basically move in tandem. But notice this, that the market tends to move before earnings, right? So it's based on expectations. You'll start to see that the market starts to pull back before earnings actually decline, starts to move forward. That's why they always talk about markets are always moving 6 months ahead of what's coming down the line. You can look right here. This is 2008, 2009. They started selling stocks before those earnings actually came in. Then they started buying them. Look at the pandemic. More importantly, what's going on right now, you can see that they are selling the market likely ahead of worries about earnings. If you like this type of content, make sure to like and subscribe to our YouTube channel. It helps us out. So if the big investors are worried about a potential earnings decline, that could mean that we could go into a recession, right? So maybe high commodity prices are going to derail the consumer, maybe high inflation, high food costs, right? If they're spending money in those places, they're not going to have as much money to buy discretionary goods, right? It could really mean havoc for the consumer. Now, I'm not a big bear. This is just the way the market thinks. And so they sell stocks when they think earnings are going to decline. And last week I showed you, March 7th, we had the biggest day of selling since the pandemic lows. Typically, these big sell-off days, we get big relief rallies. And so far, we've had very big gains in the S&P and the Qs since that sell-off. Obviously, we had the Fed, but let's keep going. So if they're worried about potential earnings declining, right? Potential recession fears, they can sell growth stocks, and they have sold technology stocks relentlessly in 2022. Literally almost zero buys in 2022. Okay, one of the biggest and deepest bear markets. Okay, so should we be worried that we might potentially go into a recession? Well, let's go ahead and look at the data now. So look, if earnings are expected to decline and people are worried about a recession, well, let's look at prior recessions. Okay, so I went back to 1980 and we've had 6 recessions since then, right? Some notable ones are the COVID-19 recession. We also had the global financial crisis, early 2000s, etc. So in this column, I've got the start month of the recession. I've got the end month of the recession. Okay, now check this out. Here's how the S&P 500 performed during those recessions. So the main takeaway is the average fall was 6.72% for the S&P. But get this, the big outlier event, the nasty drawdown was during the global financial crisis. It was absolutely terrible. I remember it so bad. But check this out. In the 80s, those recessions, the S&P actually gained during the recession. So a lot of people might think that, oh, markets only go down during a recession. Well, obviously they don't. Now we can see that the pandemic, it fell about 10%. That was a nasty pullback. But look at this, 1 year after the recession, we get out. How did the S&P do 1 year later? Well, we all know that COVID-19 really goosed stocks. Stocks rose 48%. You can see the early 2000s was a big losing year. But in general, stocks tend to recover. So there is some light at the end of the tunnel. You look over here for 2 years out, it's still an average gain, double digits, 13%, not too bad. So now that we've looked back at prior recessions and what we can expect for markets, we just had big news from the Fed, right? They raised interest rates 25 basis points. That was definitely in line with expectations. But what did we notice in the data? Even though the market rallied huge, it wasn't a ton of buyers that came in, but there was definitely a short covering rally as far as our data is concerned. We didn't see a ton of selling, but on the margin, it is very positive. And I also think that it is worth noting that whenever selling starts to dry up on a big rally, you look at some of the worst ranked sectors for that outperformance, right? And what has been getting killed this year? It's been technology and discretionary. Why? Because analysts and big fund managers, they are worried about earnings growth in these areas, right? Because we're worried about high inflation, we're worried about commodities. Can the consumer keep up in this type of environment? So when you see the bottom of the barrel, when they start to see less selling, you could see a big squeeze higher. That's what we're seeing right now. So look, stocks follow earnings. There's a 95% correlation. And if big investors think that earnings potentially could fall in the future, they are going to pound stocks. And listen, if it gets really bad, we could potentially slip into a recession. We covered a lot of that earlier, but the bottom line is, yeah, they can be painful, but eventually they end, and those can be great times to pick up great stocks on the cheap. If you're also looking for stocks that potentially do well in recessions, check out my last video. I'll put a card here for best stocks to buy in a recession. These are stocks that have done very well during past recessions. And finally, if you're looking for new stock and ETF ideas, tune in. This Thursday, we'll be releasing a new video. I will see you guys next time. The number 3 recession stock is Johnson & Johnson, huge healthcare name, big biopharmaceutical giant. They have been around for over 130 years. So whenever you think about recessions, who's going to be able to hang in there? Who's going to be able to weather the storm? Big healthcare companies like Johnson & Johnson start to make sense.